Happy Friday. Happy Mother's Day. Hello, James. Hi, Jellen. Hey, Delaney. I always love seeing people in video. It's good to know
Hi,
you're not just names out
how are
there.
you doing?
Good. How long have you been coming?
This is my first time.
I was gonna say I didn't recognize your name. Okay.
Yeah, somebody referred you guys because you're ex Intel employee, and
Yep.
that is my current W-2 right now.
Okay.
Yeah, and
Great.
I'm
Most
looking
people
into
hear that.
multifamily properties.
Yeah, this club started as an Intel employee club, and we ran for 4 years that way.
Hey
And
man, good job. I've
yeah,
been looking for like a team I can join that I can relate with.
very cool. Yeah, I think, 2 years ago when I got laid off of Intel about 2 years ago, my entire team did. And that's when this club went out from being an employee club to publicly open. But I think that something like 70% of the people here are still Intel.
Oh, nice.
Yeah, it's a large group. I don't know the exact numbers. Maybe I should add that to the poll I'm going to send out today. Yeah, it's more curiosity than something I need to know. Welcome, everybody. We're going to wait just a few more minutes as we're getting started. Feel free to join Delaney and I and put yourself on video if you want. I always love seeing that, but don't no pressure. You don't have to. I have had a lot of talks with people that are new to the club recently, and so I thought it was time to go back to basics. And that's why this week the title of the talk is "Ladies and Gentlemen, This is a Football." And I'll talk a little bit more about that in a moment as we let people join. Delaney, where did you find the group? Did you find it through your Delaney's brand new here, so I'm gonna pick on you a little.
I'm okay, man. I would like to let people know who I am, It's not who you know, it's how many people knows you. So,
Go for it.
I got it through networking, online networking. I believe it was Brian, Brian's networking.
Hmm.
And the lady that sent me here was Prolet. I don't see her here.
Oh yeah, yeah. She's here usually each week. I don't see her here at the moment.
Yeah,
She
she
was not an
directed me to
Intel
you guys.
employee.
No, she wasn't, but she has some good thing working on her end. That syndication calculator or something.
Yeah,
Oh, yeah, yeah,
syndicationtracker.com.
tracker.
My cat seems to have taken up residence on my desk. Good timing there. Hello, everybody. We're going to have a back to basics talk today, and it's going to be interactive and dialogative and Socratic. And so let's everybody feel free to put yourself on video if you like, but no pressure. You don't have to. Usually, the way this group has operated is we bring in a speaker, and most people just listen to the speaker and they present on what their specialty is. But this is a good week to be a beginner at the club because we're going to do our back to basics. All right. And as people are coming in, we'll start kicking it off at around 12:05. In the meantime, does anybody have any opens? I've had some good connections with some people who want to help out with the leadership team, which is basically a team that helps us identify speakers and do some of the fairly minor administrative work. Identifying speakers is the big portion of it, and then making suggestions to help the club run better. So I know Anita, we need to connect on this more. I don't know why I haven't connected as much, but let's just get on a 15-minute call and talk about how we can work together. And
Yeah,
I've had several other people do the same. Yeah.
that would be good. Just call me. I'm usually
Okay.
available because I know you wrote me, but I haven't gotten your emails. I don't know why, and I've been like searching. I don't know. I looked spam and everything. For some reason, it's not getting.
Probably there. Well, and that actually brings up another point. If you're joining this and you've subscribed with an intel.com email address, I really highly encourage you to go back to alternativeinvestingclub.com and subscribe with a personal email address. Intel at times has had difficulties with their DNS, with whatever their network administrators are doing, but the page hasn't always loaded correctly. And I have no idea if the emails are getting through to that domain or not. And potentially someday, they could just all be blocked. And I would have no way to contact people. So if you want to maintain the email list, or if you want to be on the email list, sign up with your Gmail, your Yahoo, your Hotmail, whatever. All right. Any other opens? All right. Well, then let's get going. Let me share my screen. And also, the other thing that I want to mention too is that this club's ability to attract top-notch speakers, and we have had a lot of top-notch speakers over the last 6 years, is dedicated on our ability to grow the attendees that are here. And so, if you've appreciated this club, please, I ask you, if you want to give back, go invite a friend to this club. With about 50 people in the club or joining on a Friday, that's about the bare minimum I could really, quote a speaker and expect them to respond. So if we want to continue attracting some of the top rate people that we've had here, we need to boost our numbers a little bit. And I'll be working on that in terms of social media too. But I'm not very good at social media. So if you're good at social media, and you're willing to help out, please join the leadership team, because that's an area I need help in. I personality-wise would just rather not be on social media most of the time. All right. Let me share my screen and we'll get started. Take yourself off mute at any time if you want to ask a question. Since I'm the speaker today and we're talking about the club itself, this is going to be fairly informal. But we're going to go through each of the real estate categories and other alternative investment categories that we've talked about in the past. Maybe not every single one, but the major topics that we've talked about, and just kind of do a back to basics class. What are we doing here as a club? Why are we here as a club? What are we trying to accomplish? And how can we help and support each other in order to do that? And also, how can we figure out what we're interested in investing in? I know that most people, and I'm sharing my screen now, I believe, most people, when they join this club initially, are interested, and maybe they have some experience. We've had some very experienced people in this group, and we've had some very, very, intro people in this group. And that's great, because you have an opportunity to go back and learn from literally hundreds of speakers. And shout out to Glenn, who mentioned that my speaking search box here wasn't working correctly. It's working correctly now. So if you want to come out here and find, information on, I don't know, syndications, you can come here, type it in, and you'll get people that have syndication in their title. Or if you want to look up a particular person, you want to find all the I don't know, all the Daniels. I've spoken here quite a few times. Daniel Brown, Daniel Brennan, etc. I'm probably pretty soon going to put up a categories area as well here, so you can click on categories. But you can say, mortgage notes or something with note in the topic, and there'll be a couple of those. So feel free to just dive in here. All of these, if you click on them, are going to bring you to, they'll at least have a YouTube link, and oftentimes a summary of what was going on, even though sometimes they're not formatted the best. And of course, all of these are on YouTube as well. So if you want to go to YouTube, and I need to switch my account there, but we're all on YouTube. Here it is. And you can go to videos or live. Live has got most of our recent live talks that are here. And there is just a huge wealth of information here. If you want to learn about any real estate topic and most passive investing topics, such as oil and gas or debt validation or litigation finance or how to run your own note fund or how to invest in mortgage notes or how to invest in an RV park or a mobile home park or tax liens. It's all in here. So feel free to browse around and check it out. We've got our past 290 or so meetings posted here. And of course, we meet every Friday at noon. I think you all know that. So as we're getting started here, I'm actually going to jump down to this slide here. And I've got the before the talk survey. And I would love it if everybody here could go and click on this and go take this. Basically, it's just going to ask what type of real estate are you, well, here, let's bring it up. Rate your experience. Are there any ways the club could be more valuable for you? Do you have any suggestions on building the club processes? And what type of investment are you interested in investing in? And if yours isn't here, you can click on Other. And then lastly, any thoughts or feedback. And if you want me to respond, just leave your name and email address here. Otherwise, it's anonymous. So I would really appreciate it if everybody would do that. I'm going to hit the cough button here. All right. And then there's also an after the talk survey, which you don't have to take, but you can, to let me know if anything we talked about here changed your mind. All right. So a little bit about me. And like I said, feel free to unmute yourself and interrupt. Nobody's moderating this. That's usually my job with the speaker. So if I don't see you immediately, use a little raise your hand icon or just start, say, hey, can I interrupt? That's fine. A little bit about me. So as most of you know, I was an Intel engineer for 12 years. But before that, I graduated double major in electrical computing engineering and economics from the University of California at Davis. My first job was actually down in Silicon Valley during bubble days. But I ended up with carpal tunnel in both my hands and went to go. My uncle was a trader at the Chicago Board of Trade. So I actually stood down in the 10-year bond pit. And the 10-year bond, for those of you who know, is the financial instrument on which the 30-year mortgage is based on. And so as rates go up and down in the 10-year bond pit, and you watch on the static of the market on a day-to-day basis, that's what eventually gets reflected up to the 30-year mortgage note. And of course, the Fed changing rates affects all instruments. And so the Fed has probably, I wouldn't even say a huge effect. The Fed controls the rates for our nation. It's not the interest rate is not governed by a free market. It's set by the Fed. So I married my beautiful wife Hillary in August 28th, 2004. We've been together now almost 21 years, and I am a lucky man. We volunteered overseas for 4 years. I was in France working with a nonprofit over there, working with a lot of immigrants from Algeria that had the right to immigrate to France because of the French-Algerian wars, but they did not have the right to work in France, which created a huge underclass there and sharp divisions in the country. And honestly, it was kind of interesting to go over there and see the same sort of political conversations that we hear in the United States. They're happening over there too, and they're happening in every country just about that I've spent any time in. It's always just they're happening with their neighbors. So the same arguments being passed back and forth there. It was very interesting culturally. The completely different cultural context and the same arguments. So maybe it's a human thing. I started off over there with purchasing mortgage notes. So I actually would fund a rehabber while I was overseas, and this helped support me. I'd give him the money to about 80% of the money in order to buy a house and some money for the rehab budget. And I, in return, would take the mortgage note, which gave me the right to collect payments on it and to foreclose on it if they didn't pay me back. And the way I set it up was they didn't have to pay me anything back until 6 months. And then at 6 months, it was all due. It's called a balloon note. So 100% of the principal was due back plus 15% annual interest. And that's one of the ways I supported my family while we were overseas. My daughter was born in France. We moved back to the US in 2010. and I got a job at Intel. I worked at Intel for 12 years in the software area. I was a senior software developer and also part of the what Intel called technical marketing, and a lot of other groups call developer evangelism or developer advocate. So I did that for quite a while, and I enjoy creating communities, and that's what I did for Intel. I created developer communities. I was a little frustrated with the marketing department at times, and that was part of the reason why I actually started this club, because I wanted to prove to myself I could actually draw a crowd without the marketing people doing a great job sometimes and then not on other times. I started investing as an LP back in 2017 and then founded my company, Good Samaritan Capital, and the employee club, which was called the Intel Real Estate Club at the time. Now that it's public, it's called the Alternative Investing Club. And I have been doing this with you guys, some of you, for 6 years now. So that's the long on me. Hope that didn't take too long. The Alternative Investing Club, that's why we're all here today. And hopefully I know a lot of you have been getting a lot of value out of this club because you're here week after week after week. I am super proud of the fact that over the last 6 years, we have averaged 47 meetings a year at Friday at noon. There's only 52 Fridays in a year, roughly. And doing 47 of them on average per year. We usually don't do right after Thanksgiving and like 1 or 2 in December. But other than that, we're here every single Friday. And that's actually also why I need people on the leadership team, because I'm a little burnt out finding speakers every week, and I need some help with it. And it's just, I'm honest, that's the way it is. I really enjoy real estate investing, but interviewing and making sure I find great quality speakers it takes time. And I should be leveraging other people's networks more than I do. So I would love for people to come and help me with that on the leadership team. The other reason, too, is because I'm going to be gone for 2 weeks in June for my wife's cousin's wedding. And I need people who are able to moderate this club while I'm not here. So if you're interested in opening the Zoom channel for a speaker and having them speak, and you just take and answer questions and kind of direct it, let me know. All right, so the purpose of this club is to basically bring speakers in every single Friday. And the challenge is to grow a community of people who are learning to invest in private investments. Everybody that I know of here knows how to invest in the stock market. They know how to invest in their 401k. Most people have houses that are here and have some familiarity with the real estate market, but they haven't had no exposure to commercial real estate, to different types of loan options, maybe for single family. Maybe they're new at short-term rentals or fix and flips, or investing in funds of short-term rentals or funds of commercial real estate. Or investing in small business equity or medium business equity that's not publicly available through the traded stock market, or oil and gas, or other types. There are a lot of types of other funds out there. And frankly, the education is not just, the education will take a lifetime. There's always new, and the better you are at doing something, the more creative you can be with it, and the more you control your own financial future. And that is what we want here at this club, is to basically spread financial education to help people take control of their own futures. Right now, it's a tumultuous time. People are always, somebody always thinks the sky is falling. And so isn't it great to be able to learn the tools that you need to take your own investing into your own hands? And that's the goal of this. We bring speakers in one of 3 ways. The first way is purely educational, meaning that I heard them on a podcast. They were recommended to me by another speaker or another person in the group. I pre-screened them, found out they knew what they were talking about. We brought them in order to give a purely educational talk. And educational talk should have no sales pitches whatsoever. They can leave their company name so that you at the club can go and contact them. But I also never provide, under any circumstances, the names and email addresses of anybody who's in this club to any speaker. I've never done that, not even once. It's all GDPR compliant. So And even if it wasn't GDPR compliant, I would never send those things out. I use them basically just for the weekly, this is what the speaker is going to be this week, which if you haven't got that email, it usually comes out Tuesday or Wednesday, and sometimes Thursday when I'm busy or slacking. And so it comes out and lets you know what's happening this week. The other thing that this club does is we like to provide pathways to investment or on ramps for people to dip their toes into the private investing world. And we do that in a couple of ways. One of the ways is the pitch talk, which is the second way that people come in. About 2 years ago, people came to me, actually in this group, on this call, and said, "Hey, Daniel, we get a ton of great education, but now that we're no longer at Intel, you should bring some pitch speakers in because we have to go to other locations in order to find deals. We get our education here, but we have to go somewhere else to find the deal." So I started offering pitch talks to people there, and yes, I do charge for them. So that money goes into the software of doing this, and also to compensate me for my time because I spend a fair number of hours each week working on it. So, and I'd just be upfront. I charge $2K for a person to come in and give a pitch speak. I think it's lower than most other clubs, and I think it provides a lot of value to this group. So we bring people in that way, and then the third way is through the club fund. And the club fund is specially put together to target income producing with some capital appreciation and good tax benefits. But income producing is the number one thing. We don't invest in anything that doesn't produce income pretty much within the first 3 or 4 months, preferably on day one. And we tend to invest with larger groups that have teams of 20 or more people working at them. No small syndicators, no, individuals running note funds. No, they have to be developed companies that have established track records. And the idea there is that a lot of those are semi-institutional or institutional deals, and they have minimums of like $100,000 or $200,000. Our first investment in the fund was with DLP Capital, and their minimum was $200,000. And so the fund is also a way to let the club aggregate our money together so we can get into these better deals. And so the club's minimum is $25K, which is honestly from the ability to manage the number of people that are in it and to pay the accountant and to pay the taxes. $25K is about the lowest, and unless you're going a crowdfunding route and you've got a larger organization helping you out. 25K is about the lowest you'll see out there for private market equity opportunities, minus the crowdfunding groups. So we're at 25K, and if we have a speaker come in and they present their talk and the club really likes it and we get 8 people to put in 25K, we'll earmark that $200,000. We'll put it in that speaker's deal, and that becomes part of the club's club fund. And everybody that buys into the club fund gets a diversified basket of the people that the club has funded in. So it's not as though you're investing just in the one talk. You're investing in the club fund that gives a voice to the club on which people the fund should invest in. And then when you buy the fund, you're getting a diversified basket of all of them. I'll stop right there before we go on to our actual what types of assets do we study. Are there any questions? Am I boring you? Do you all know this already? I know we have new people in the group. Where can I find the link? Oh, there's the YouTube link. Thank you. Thank you, Berhanu.
So the CIA investment, is it income deductible? Like a K1?
Yeah, it is. You'll get a K1 for it. And then the tax advantages are just the weighted average of each of the investments. Most of the investments that we invest in are tax advantaged. DLP Capital is notably one that's not, because it's a REIT fund, and so it provides income on a 1099. But the fund itself takes in and distributes K1s. How about links for the surveys? Oh, let's go back there. Sorry. Link for the survey. I'll throw that in the chat. No other questions. Okay. Let's talk about,
And
yeah.
have you seen how the club performances, the funds are performing? Have you produced anything like that?
Yeah, so the fund has been around since October of last year. So far, we've been paying out about a 7% annualized cash flow, and that started January. I haven't put out a quarterly report yet. Actually, I'm gonna start doing that and presenting it here in this meeting, and it'll be just like a 2-minute update on the fund. So that's how I'm planning on sending that out. All right. Right now, we've also invested in the debt validation fund, and that's one of the investments that will take 3 to 4 months before the monthly cash flow will start. And so we're returning about a 7% now, but I expect when that income starts coming into the fund, we'll be able to raise that over the 8% preferred return that the fund has. All right. Please go ahead and take the survey. Next here, when learning to invest, it's important. Everybody that I talk to on the phone when I'm on an initial investor call has got a different why for how they're voting. And they do fall into different buckets. You know, I'm saving for retirement, I'm saving for a house, I'm saving for my kids' education, I just want to invest in order to, you know, grow my wealth. I want to create long-term wealth for my family. Lots of different reasons for being there, but everybody's got a different story and a different why. And so that feeds into just understanding the more creative you become with investing, the more you'll understand your own personal risk tolerance, your own personal desires in terms of, do I want income versus appreciation versus tax benefits? Tax benefits is one of the huge benefits that you don't get in almost any other type of investment. For instance, our oil and gas and most of the syndications that we've been a part of have provided tax deductions. Of the oil and gas fund that we just participated in provided an 86% deductible tax expense. So for every $100,000 that was put into it, $86,000 of income became tax deductible. So you would take your normal income tax deduction on that. Again, I'm not a CPA, I'm not a lawyer, I am not a financial advisor. I don't give legal, tax, or financial advice. I'm an investor, just like you guys, who talks with a lot of different people that are in these fields. Also, you get to decide how hands-on you want to be. So, for instance, if you've got a high risk tolerance or maybe a mid-range risk tolerance, and you want to be more hands-on, you might consider single-family homes. So let's go through some of this right here. A single-family home is probably what most people start with and are most familiar with. Homes are in different markets or different MSAs. So a lot of people are in the Phoenix market, the Folsom market, the Portland market here. Maybe they have vacation homes in Idaho, Florida, Hawaii, wherever. And these markets all perform differently. The Sun Belt over the last few years, over the last 2 years, has not performed very well. But 3 years before that, it was performing very well. And so different markets actually go through different boom bust cycles at different times. And so what's interesting to be able to do with real estate is to be able to identify these markets, invest in them during the boom sections, and then hold on to your properties through the bust. But as some areas are busting, for instance, right now, the bluer states on the coast in Chicago and Illinois are tending to be doing a little bit better, depending on the market. It's still kind of tricky. You have to choose a hyper local market in each of those scenarios. But some money has stopped flowing into the Sun Belt states and has started moving back towards some of the coastal states. So understand your market, understand which markets to get into at what times, and then understanding just the investment itself and how it works. You have a home, it's got a certain number of square feet. Often it's priced by the number of bedrooms and bathrooms. Residential houses are appraised by an appraiser, and they use what's called the comparable method of appraising, meaning the appraiser is going to come in, they're going to try and figure out, all the little things that your house features, and then find the 4 closest houses that are like it in your area, and whatever they sold for, that's probably about what yours will sell for. That's called the comparable method, and it's done by, a licensed appraiser. With commercial real estate, it's different. That's done through the income method of appraisal, very similar to how a small business is evaluated on EBITDA. So the income that's brought in is subtracted from the taxes and the expenses and the amortization. And I do see a hand. And the income, the value of the company is a multiple of the income that it produces. Well, that's the same with a commercial real estate project, which is 5 units or greater. And that's actually defined by Freddie Mac and Fannie Mae, and all the commercial banks abide by that. You get different loan terms if you have 5 units or more than you do 4 units or more. And in fact, it's mortgage fraud if you try to, get a loan with better residential terms on a commercial property. Who's got the raised hand here? Lower your hand. Go ahead and speak, AA.
Yeah, so you mentioned the blue states right now are doing better in the housing market. Where you get your data from? Just how you know that?
I get a lot of data from Corfac, and also there's a couple of different places. Marcus and Millichap gives really great data, but in the commercial industry, there are research papers, just like in technology, there are white papers that are made available. So there's a lot of groups that do that. My commercial lender has a subscription to quite a few of the data services, so I can usually talk to them and they'll pull a report for me.
So you said Cold
Jeff? A lot of it from just people's experiences too, interviewing people all the time.
Thank you.
Yeah. That's why, actually, an hour before this, I interviewed a small, mid-size, I'd say, a mid-size syndicator in the Chicago area. And I think they're going to be on next week or maybe in 2 weeks, giving us an update on the Chicago real estate market. All right. So another interesting aspect of private equity in real estate is in that category is that you can take out debt. You can borrow in order to acquire the business, the asset, the oil well, whatever the real estate, whatever the asset happens to be. You can borrow money, and banks know that because that asset creates income, that they have a revenue stream that you're going to be able to pay your loan back on. And there are governmental agencies, obviously, or quasi-governmental agencies, Fannie Mae, Freddie Mac, that specifically operate in the real estate markets. Jason Teeley, who is one of my best investing friends, and we've done 2 real estate funds together. He is a vice president at Fannie Mae, and we talk he's a very friendly guy. And he doesn't tell me anything that's insider per se. He doesn't tell me about anything going on at Fannie Mae, but I can usually bounce ideas off him and say, hey, what do you think of the market in this area? And that's quite nice. So just having people that you're able to talk to about mortgage loans. Fannie Mae subsidizes that and uses federal dollars in order to provide low interest rates to a large number of people throughout the U.S. Loan origination fees. This is the fee taken that the bank takes for creating the loan. It's usually way too exorbitant, in my opinion. Depreciable closing costs. So other costs that are involved with closing it. Depreciable means that you can, over time, deduct them from your taxes. As the assets, over the life of the asset, you can create tax deductions because the asset is wearing down, and that asset, as it wears down, is an expense, and business expenses are tax deductible, and so depreciation is a tax deductible business expense. The amount of cash you need to bring in, cost per square foot. how much income a property can make approximately based on comparable rentals within the market. I actually just pulled this up. This is the address of the property if you're interested in it. It is in the Arizona Casa Grande area. Operating income. So operating income, just like a business has operating income, every property has operating income, and that is going to help determine whether it's worth buying or not, and what the value of it is or not. In mortgage rates right now, you can usually still get a 75% loan to value in the residential areas. In commercial, money is tightened up a lot more. That's another difference between commercial and residential, is that the liquidity or the tightness with which the banks treat the loans changes a lot. Back in 2020, before the pandemic, you could get 80% loans, 80% of the money for the property funded by the bank. Right now, most people are getting 55% loans, or maybe 60. That's about the average of what most commercial loans are doing nowadays. And so it's become much more difficult, and people that are interested in investing have to raise a lot more money from investors. And of course, investors require 8% return plus part of the upside, which is a whole lot more than the bank requires at their 7% interest or whatever it is. So it's a more expensive source of money, which means that the overall project has to be a better project to be able to support those investors. So as loans tighten, projects have to become higher quality in order to meet the same return benchmarks. Debt coverage ratio. That's actually, it's not a particularly great debt coverage ratio. Most commercial banks require 1.25. And that is simply the amount of income that you make versus the amount you pay on your loan. They want to see more income than you pay on your loan. Let's see here. Cash on cash return. That's interesting. It's at a 0. I'm actually not surprised, because this is so tight right here. The amount of money being made is about the same amount going out to the loan. So this particular property, you're not going to be making your money from monthly income. It's all going to be on when you sell the property or refinance it. And keep in mind, you're going to be putting money into this property, whether it is CapEx expenses like changing the roof or changing the siding, which are one-time large expenses, or whether it's regular maintenance expenses like lawn maintenance or electrical utilities, things like that. All right. And then, of course, property taxes, insurance. If you have a management company for a single family home like this, you're looking at 7 to 9% of the monthly takeaway is what a management company would take before expenses. And then you can calculate out your net income and what you think your profit is going to be. And we can have a specific talk on just calculating all of these if you want to go more in depth on it. We could do the same thing for fix and flip. So the nice thing about a single family home is it's a stable asset. Everyone knows what it is. Fix and flip, you're in the higher risk category. You're in the higher outlay of initial capital, and you are in a high outlay of your time. And it's not taxed, what I would call a tax beneficial tax status. So fix and flips are you don't get a lot of depreciation. If you hold it for longer than a year, you'll get short-term capital gains. If you hold it longer than a year, you'll get long-term capital gains. Or rather, shorter than a year, it's taxed at income rates. So oftentimes people are looking to buy houses that are ugly, turn them into beautiful houses. They're putting value into the economy, and they are reaping the rewards of their hard work and their capital outlay. So these are all over the board in terms of these numbers right here. This is not necessarily representative of any given home, but it's supposed to be representative of the type of work you're getting into, that you'll get a high rate of return. You'll get no cash flow along the way. You have to manage all the repairs yourself or hire somebody else to do it. The market can change while you own this. It could go one way or another, and it might completely change your ability to sell the property. So it's always good to go into these thinking that these should work if they have to become rental houses too. I usually hold it for a couple of months, and it's open to non-accredited investors. Anybody can go buy a house that qualifies. And is it tax advantaged? Usually not, because it's a short-term hold. Longer-term holds are, of course, more tax advantaged. All right, short-term rentals. We've had a number of talks on this. I should probably go over to the site here too and just talk about, all the people that have talked about short-term rentals. Boy, this is where categories would be better. But if we have STR in here, that's not good enough. I don't know if short is going to come up here. But we have a number of people that have talked about short-term rentals and what their strategies are. Most people nowadays are looking for that really luxury experience, or location near a hospital or a government facility, or somewhere where there might be temporary workers coming in and staying for medium term, maybe 1 to 6 month lengths. Short-term rentals tend to give a little more ROI, maybe double the ROI depending on your short-term rental. But they also have a lot more expenses, because every time somebody goes in or out, you have to clean the place. The expenses on these are frankly ridiculous. It's often $250 to clean a standard home after each person's been through, and so the effort is higher. You might be the one cleaning. You might be hiring a service to do the cleaning. I have a rental property in Idaho that my wife and I manage, and it certainly takes a little bit of time. We talk to every person that's there, and we change around the scheduling for them, and answer any questions they have, and then of course talk with the cleaning lady, who's also our local area representative there. The county requires you to have a local person on call. The cash started to require is similar to a down payment plus whatever the management service is here. This is another thing. If you have a third-party manager of short-term rental, they often charge 20% of the income. So because there is a lot of work involved with this, and so it's higher than almost any other management fee of real estate that I know of. In the case of my wife and I, we manage it ourselves. We're talking to the people that are going in and out, and so we don't pay that 20%. We do it ourselves. The hold period, you can decide it's open to non-accredited investors. For those of you who don't know what an accredited investor is, the SEC, the Security Exchange Commission, sets the definition for accredited investor, and it's done to protect people largely from getting into real estate, not real estate, but just any security that they don't understand. And to, of course, protect people. And not understanding it makes you open to predators and fraud. And so the SEC sets these definitions in place because they want to reduce the amount of public fraud that takes place. And so the accreditation, the two major ways that people qualify for accreditation are under the income test and the net worth test. And the income test, excuse me, income test says that you need to be a single individual making $200,000 or more for the last 2 years, with the reasonable expectation that you will make it again this year, or you need to be a married couple making $300,000 over the last 2 years with the reasonable expectation that you will make it again this year. And if you qualify into that, you are qualified as an accredited investor under the income tax test. The net worth test is where I think most people qualify, or a lot of people qualify, and that is, do you have $1 million of net worth? So that could be your 401ks, your kids' educational accounts, anything that's in your name, but it can't include your house, your primary residence. It can include your rental house, can include your syndications, your properties, your oil wells, whatever they happen to be, whatever your assets happen to be, but it can't include your primary residence. And so that is the net worth test. And if you qualify for those, you can get into deals that syndicators and other private financial groups offer to the public. And the main protection there is that the people that offer these deals are not allowed to publicly advertise a deal unless they limit it to accredited investors. And so the people that are running these deals have to go and declare that they are 506B or 506C, or some other designation in the tax code. And depending on how they declare their investment, their security, they have regulations that they have to abide by as to whether they are allowed to publicly advertise or not. If you have a 506C, it's only available to accredited investors, but the person can go, paint the advertisement on a bus bench, or advertise it on Facebook, or come to a club like this. People that have 506Bs can also come to a club like this. They just have to tell everybody that only accredited investors can come in. So I went over into commercial space while I was talking about short-term rentals. But are there any questions on what I just spoke about: accredited investors, short-term rentals, single-family homes? I hope this is a football session, because there's a lot of people that are new out here, and I want you all to feel like this is an area. Some of the people that come into this club and speak have obviously been doing it for a long time, and I think a lot of it can go over people's heads. And I've been doing this now for 6 years, so it doesn't, and I'm running the fund, and so it doesn't go over my head. And so sometimes, or at least when it does, I like that because it's something new. But sometimes I probably lose touch with people who are maybe brand new, and it's good for me to keep that connection. So I want to know, if a speaker comes in and talks over everyone's head, let me know. All right.
Yeah, Daniel.
Yeah.
In all of these short terms or fix or flips, from the perspective of staying a passive investor and bringing in track record people that are looking for capital that can help those types of deals, are those network elements that you're also trying to bring in here, or are you?
So you're talking
in
about a fund of short-term rentals, or?
Yeah. So obviously tapping into an existing thing that's looking for capital to expand their fix or flips, or you know what I mean? Like,
right.
So how do you?
So correct me if I'm characterizing any of your question wrong. Most of the people in this group are probably looking for passive income.
Yeah.
And passive income comes when you're not the one managing it, somebody else is. And so there's you as the passive income investor have to vet the person to make sure they know what they're talking about. They have a track record. They have a good business plan, that they're in a good market, that their plan is not too risky, and a host of other things. So you need to, and then anybody who's managing those things for you is creating a passive income instrument, basically. Just like from that perspective, a stock would be a passive income instrument, even though it fluctuates on a day-to-day basis. And one of the reasons why I like real estate is because I don't have to check the stock market in an unhealthy manner, which I had got into when I was doing a lot of stock investing. So funds can be created around people doing fix and flips. Funds can be created around short-term rentals. So you say you have a company out there and they manage 20 short-term rentals and they want to acquire more in a particular area, say Phoenix, Arizona, or Sacramento, California, or wherever. They're managing all that for you, and their business strategy is running a portfolio. There are a lot of groups out there. We've had some of them. I have actually kind of stayed away from fix and flip just because, and maybe I'm wrong on this, but it's usually a highly involved thing. And so I didn't think this group would be as interested in it. If somebody else has a whole fund doing it, that is of interest. We did have, I think, one of the Daniels that was pulled up here, Daniel Brown. He's involved in development, but he develops, individual houses, and he has a fund that helps him do that. So you could be involved in the strategy of development of single family homes. Go watch his talk if you're interested. We have had one group that came in and was doing a fund of Airbnbs. They were out of Phoenix, and I can't remember their name off the top of my head. But if you want me to, I can go find it for you. They're out there. Put inside the survey if there's a particular thing that you want me to go find. Okay. All right. With that, real estate syndications. I think a lot of people in this group know what they are. Oh, REITs. Let's start with that. I'm going to go through it really quickly. I don't invest in REITs at all because they're taxed as normal income. And so they're basically buy an asset, distribute the income off of them. They have market volatility, and I primarily look for tax advantage investments that don't have market volatility or day-to-day market trading. A REIT is based on whatever the current sentiment is in the stock market or the trading market, whereas most real estate moves much slower than that, and the prices change much slower than that. They can move suddenly when they do change, but they don't change on a day-to-day basis. So that's why I don't particularly invest in real estate investment trusts. But if somebody wants me to bring that in, it's a worthwhile topic too. I mean, it gives regular income. And so there are definitely people who want the regular income, who maybe are retiring or just want more income. That could be a good strategy for you. Real estate syndication passive, like we were talking about earlier, this is where, and this is highly, this is kind of a generic outline of what most syndicators say that their investments will bring in. But it tends to be a little better risk reward because it's kind of splitting the difference between a fix and flip and a single family home. You're actually buying an apartment and you're renovating the whole thing, or an office building, or some sort of industrial or commercial property. You're putting in place a new business plan, whether that is lease it up, change the financing, change the people that are doing the property management, go into an agreement with the city for a tax exemption, whatever your business plan happens to be. This is a larger multi-unit complex usually that's purchased, and you're adding value to it, and that's why the ROI is bigger. It's not as big as a fix and flip because it's more than one unit, so it's averaged over a larger group, and it's, in my opinion, not as risky as a fix and flip. It also gives, sometimes, good cash flow. Recently, with the real estate market, a lot of deals have not been giving good cash flow over the last 2 years. It's low effort for the passive investor. They just need to identify the person of the deal and investigate them. You can get in at lower price points. 25K is pretty unusual. 50K to 75K is normal. A lot of them are doing 100 or more now too. The hold periods, multi-year hold periods, so you qualify for long-term capital gains. It's open to accredited investors sometimes. Some deals are 506B, some are 506C, and it is tax advantaged because you usually get a heavy amount of depreciation, 60, 70% depreciation, often front-loaded into the first year. So you'll get a big tax deduction in year one of the investment.
Yeah, Daniel, quick question regarding that. So how many non-accredited for that 506B?
For the
Unlimited?
506, no, you can only have up to 35. I'm sorry, for a 506. Yeah, I'm sorry, I'm getting myself confused now. 506B, you have to know every single person, and you can. I'm getting it confused. It's 35 unaccredited people, I believe, can be in it, and an unlimited number of accredited people.
All right, thank you.
Okay, so with all those things, we can talk about commercial parks, and we have had a lot of talks on commercial parks. There was one last year on industrial real estate in Utah, and he did a great job of laying out a lot of statistics on how you would evaluate an industrial property and the market that it's in and where the path of progress is. So I highly recommend that. There's residential tax liens, which we haven't done as much with, but they're an interesting individual strategy. Mortgage lending and private note investing. There are a number of funds out right now. As real estate has become a little more risky, people that want to reduce the risk have moved from equity funds to debt funds. And instead of purchasing equity in buildings, they're actually giving out the loans for the buildings. And there are a number of reasons why that is a more secure financial position. The main one being that when the property and the LLC that owns the property is liquidated, debtors get paid back, or creditors get paid back first before any investor that holds equity does. And that's based on state law, and all 50 states, I believe, do it that way. So with that, I'm going to open it up to questions in the last 5 minutes. Thank you so much. Actually, Good Samaritan Capital is not where I want you to go. I want you to go to alternativeinvestingclub.com, and you'll find all of our club stuff here. And with that, I'll open it up to questions and also to the final survey. If you changed your mind about anything here, let me know. And I hope that was a useful overview of the types of deals. I should also mention that a year and a half ago, this group asked me to talk about more deals that weren't just real estate. And so we've had oil and gas people. I've been looking for a solar energy company. I've interviewed a couple. They don't tend to respond back very well. So for whatever reason, I've been trying to find a group that builds solar farms or hydroelectric power. Renewable energy is another interest of mine that I think this goes well with this club. We've also talked about, we had one person come in and talk about his fund where he bought expensive bottles of wine and whiskey and barrels of whiskey, and he knew how to buy them low and sell them high, and that's how he made his fund work for investors. We had another person come in and talk about debt validation, and this is a newer strategy where the group will go out and hire marketers to find usually like people that have high medical bills. Medical bills are the #1 cause of bankruptcy in the United States, and veterans and first responders have a lot of medical bills. So they often, try to target that, which I think is a great thing you're doing for them. So you're going and finding, they'll place ads that say, can you pay your medical bills? Are you a first responder? Contact us. We'll help you out. And the first responder or whoever it is will contact them. And oftentimes they'll look at the person that they owe the money to and just to validate, is that creditor following all the Fair Credit Practice Acts? And if they aren't, they can take that to court and invalidate oftentimes up to 50% of the debt. And so the first responder gets a reduced amount they have to pay. And then, of course, they purchase that debt from the creditor. The creditor will often sell it at a very low rate because oftentimes the first responder or the veteran may not be paying the bill because it's overwhelming them. They can purchase that, and instead of paying 30% on their credit card, they lower it down to 5% or some reasonable amount, and give them, in the case of the people we worked with, they give them a 2-year plan to help pay it off in full. And because they can invalidate a lot of the debt and they can pay the creditor 30 to 40 cents on the dollar for a non-performing loan, they can then turn around and give both the first responder veteran a great rate and a path to paying it off, and they can give an investor return. So I particularly like this one. The business plan here is basically going through the marketing and legal legwork in order to find and invalidate debt. And I kind of like this one too, because you're not just dealing with one unit. Usually you're dealing with like several thousand contracts per month, which means is the risk is amateurized over a much larger group of people. And so your default rates and all those things are really well known going into a deal like that. We brought in a group that talked about airlines. and how you can buy an airline and buy an airplane and lease it back, or you can be a partial investor in an airline engine. I'll just keep talking unless somebody wants to interrupt me.
I have a question.
Yeah.
So I know there's a lot of investments for people who have, like a lot of money or accredited investors, but like for somebody who doesn't have a lot, what do you recommend they use to get started? Like what kind of investment vehicles would you kind of recommend?
Well, and it depends on, if you don't have a lot of capital, you're usually going to have to put in time. And that is one of the kind of universal trade-offs. You can work for money, or your money can work for you. And that does tend to be how it breaks down. And so in the real estate world, there's wholesaling, there's fix and flipping, there's contract assignment, land flipping. We've had a couple of groups come in on land flipping. The idea behind land flipping is you go and send 5,000 letters out to people who own vacant land and say, I'd like to buy your land for 30 cents on the dollar. And a lot of times the title is messed up because it's vacant land that somebody inherited and they don't know what to do with it. Or maybe 5 kids inherited it. And so the title is messed up. And so you might have to gain a little bit of proficiency in how to fix a title or have a lawyer fix the title. And you buy it for 30 cents on the dollar, and then you turn around and sell it for 60 cents on the dollar. I don't tend to be a huge fan of that because you're not really adding value to people, to the economy, and some value, I guess, but not a lot. But it is kind of a truism that if you don't have a lot of capital, you're going to be spending more time. Wholesaling would be the way that most people go. Wholesaling is just finding a person who wants to sell low, putting it under contract either with an option or just buying the home outright, and then maybe fixing it up a little, maybe not. But then a wholesaler will often have a network of people that like to sell houses and fix them up. And they will then sell the contract for that house to the person who wants to fix and flip it. So it's low work on their side. They just have to identify the property and put it under contract. And then they turn around and sell it to a flipper. But it's work. It's definitely work. I see we're over time, but since it's not a speaker here, I'm willing to stay on as long as people want. Otherwise, you're free to go. And I hope you call your mother on Mother's Day. Have a wonderful, wonderful weekend. And I'll stay on here to answer any questions.
I don't know if you got in touch with Justin about the speakers, but a lot of the...
What was his last name again? I do remember talking to him.
Smith.
But yeah, Justin Smith.
Yeah. So they were gonna talk about deals that
1031 exchanges.
Yeah, deals that go with 1031 exchange.
Yeah.
So
let's see. I sent them my link to set up a time to do an introductory call, and they didn't respond back. Okay. So I'll go follow up with them.
Okay. Yeah, I think in general the exit strategies on real estate is kind of a big piece.
Know your exit before you get in. Yeah.
Exactly. Yeah, exactly. And in the deal, talking more about how they're setting themselves up for exits. So
yeah.
So
that's an important thing to learn. Syndications, they will usually outline their exit strategies. But fix and flips, you got to have an exit strategy of selling or renting, and you got to be able to make the numbers work in both cases. So yeah, knowing how to set up an exit strategy is key. And with 1031 exchanges, it's very tricky. And there are strategies. We've talked about Delaware statutory trusts that can change into them. They are counted as something that can be 1031 exchanged, but they're also liquid. So you can change into them and change out of them. The disadvantage to that is there are fees changing both in and out. So you'll pay hefty fees, but you may be able to continue delaying your capital gains taxes.
Right, and the deals associated to those that help you prepare when you are doing a 1031, because there's a lot of tax advantages for you to do the 1031, but this club doesn't help you at all on how to do those exit strategies. So we've had different talks about ways to do that, but when those properties sell and you want to go into a 1031, and how do you stay in front of the deals that will help you manage that? That's part of what I think is sort of missing here. So
check out IPX Exchange. So I mean, managing that and going in and out is something we would just refer you to, and I should probably put up on the club webpage a place for people to recommend legal and legal groups that specialize in that. Any other questions?
I have one, Daniel.
Yeah.
Have you seen any shifts in categories based off the tariffs that have been going on in terms of investing?
People are starting to price into their underwriting models higher expenses for materials. There's definitely any sort of new construction, renovations are going to be more expensive. And one of the problems right now is you just don't know how much to price in, because different tariffs affect different things, and depending on where they're coming, it's super complicated. Nobody really knows how to do it. So there's more, I would say at this point, we haven't really felt the tariffs yet, but there's a lot of FUD, fear, uncertainty, and doubt. And that is definitely, fear, uncertainty, and doubt drives up the expenses, because you have to start pricing them into your model to the best of your ability. And so the only way that I've seen it so far is mainly in just market uncertainty and in price of construction materials. And then, of course, foreign investors too. We had one, Eric Gao came in a year or two ago talking about how do you attract Chinese investors to your real estate deal. We had another group come in and talk about how do Canadians invest in the U.S. market. And so there certainly will be effects along those lines too.
So based off that, then I would expect that some of the categories of investing that you had listed that doesn't require materials would they be peaking, and then the ROI for the ones that do require materials to draw people in, have they changed?
Yeah. So I mean, all of those deals require materials unless the business plan specifically says we're just going to buy and operate. So in general, it's just going to make expenses go up, across the board.
Thank you.
Yeah. I think, and I don't like to get political, but I think Trump is planning on raising tariffs but lowering income taxes. And if he doesn't get the income taxes lowered, that's going to be a problem. Raising tariffs. Anyway. Any other questions? All right, then. I'll wish you all a happy Mother's Day and a happy weekend.
You too, Daniel. Thanks.